new business that a venture capitalist looks for. And we had discussed four of the points regarding superior business, quality and depth of management, corporate, corporate governance and structure, quality leadership. The next thing that a venture capitalist looks is that a strong team. Now, venture capitalists always want to see a team that is all in. That is to tell a all round team from the beginning. Now, the idea is that if the team is passionate about their product or service and can get through the bootstraps stage of growth, then they'll have a determination to overcome any kind of hurdles that they would face in the growth process. Now, venture capitalists also want to see the team share the founder's vision and offers the relevant skills and experiences to face future challenges the business will face as it expands. Now, the next one they see is a innovative product. Now, venture capitalists do not want to see a me too or also run. They always want to see that either a business provides a compelling reason for people to change from their current habits or see something that is truly new or unique. Now, for this particular reason, a venture capitalist always want to see a product that has a strong differentiators. Now they'll want to see that people don't have a reason to buy someone else's product or service instead of theirs. Now the next one is broad SOM or service obtainable markets. Now if the product or service of an entrepreneur or a firm is for a very niche market, then chances are that a venture capitalist fund won't be very much interested. Now they want to see a large market and see that people are spending much in that particular market. Now, venture capitalists will want to know about the market for the product or the service that the entrepreneur or firm is selling. Now, more than all this, a venture capitalist will want to know that it is a big market and investing there is definitely going to make their pockets big. Moving forward, they will also see for a detailed plan for how the capital will be put to work. Now, this hopefully that is without saying, but a venture capitalist won't want to invest in a business without knowing what exactly the money is going to fund. Now, this is where a financial forecast can be indirectly helpful. A financial forecast will detail out where the money will go and when, and while use existing trends and educate predictions to show how this is expected to impact revenues, operating costs, cash flow, and even the bottom line of the company. Now, the next one they see is the investment thesis fit. Now, a venture capitalist always look for companies that fit in their investment philosophy and also on the other hand complement their portfolio and even their brand image. Now, this isn't because they are snooty or something. Now, it is because due to the mentorship nature of venture capital funding. Now, they are always looking for a business to which they can best add strategic value. Now, every venture capitalist has a philosophy that underlines their approach to investing. Now, some venture capitalists are strictly in it for the return. Now, others take a strategic approach looking to support startups that will benefit their parent companies. Now, the next one is appropriate investment structure. Now, along with the requirement of the plan being a attractive business opportunity, the venture capitalist will also be seeking to structure a satisfactory deal to produce the anticipated financial result to the investors. Now, along with that, one more thing that venture capitalists see is the exit plan. Now, lastly, this venture capitalist looks for a clear exit routes for their investment. Now, it could be in the form of public listing or it can be in the form of a third party acquisition of the investee company. So now these are some of the elements out of many which makes the criteria from the side of the venture capitalist to invest in a new company or an existing company also for that matter. Now all that here they suggest is that when an entrepreneur or a fine firm does a business plan and is seeking to get help from the venture capitalists, even they, if at all they do not invest in the company, it not might be because that the plan is not a qualitative one, but many a times it might be because that the business plan might not be inside the area of the criteria that venture capitalist has it for himself. Now, moving forward, the next thing that we would be discussing is the process of venture capital financing. That is to tell how the money would be invested, how things would go on, and how the money is taken back from a company. Now, it starts with deal origination, then screening would be done, then it moves towards evaluation. Once after a plan passes the evaluation, the deal would be structured, then all the post investment activities would be done. Once all the objectives and the time frame is fulfilled, then the venture capitalists tend to exit themselves from the company. Now, this is how the venture capitalist process would be. And in that first one is the deal origination. Now, a continuous flow of deals is essential for venture capital business. Now, these deals that we are speaking of, they may originate in various ways. Now, the deals may origin because of a referral system. It might origin because of active search or it can also arise due to the intermediaries. Now, speaking about this referral system, it is an important source of deals. Now, deals may be referred to venture capitalist funds by their parent organization, could be from trade persons, could be from industry association, friends, or anybody who is into such kind of business. But even along with that, another important source of deal flow is active search through networks. Now, it could be in the form of trade fairs, conferences, seminars, or for you know a foreign trip for the sake of business or any such thing. And one more source is that is used by venture capitalists, especially in developed countries like US, is that there would be certain intermediaries, especially appointed for this purpose, who would match venture capital funds and the entrepreneurs or the potential entrepreneurs. Now, this origination of deal is the first step or the primary step in venture capital financing. Now, it is not possible to make an investment without a deal, and therefore a stream of deal is necessary. But however, the source of origination of such deals may be various. Now, one of the most common source of such origination is a referral system. Now, as we discussed once again, this referral system are deals, or it is referred to the venture capitalists by their business partners, parent organization, or friends. Now, moving forward, the next step is screening. Now, speaking about screening, it is the process by which the venture capitalist scrutinizes or analyzes all the projects in which he can invest or he could invest. Now, the projects are categorized maybe based on certain criteria. The criteria may be such as the scope in the market, or for that matter, it could be on the basis of technology that is being used, or also, based on the product, size of investment, the geographical location, or stage of financing for that matter, whether it is early stage financing, seed capital, or whether it is management buyout, etc. Now, for this purpose of screening, the entrepreneurs are asked to either to provide a brief profile of their venture, or they are invited for a face to face discussion for seeking certain clarifications. Now, this venture capital is a service industry, and venture capital funds generally operate with small staffs. Now, in order to save on time and to select the best venture, or before going for an in depth analysis, venture capital funds carry out initial screening of all projects on the basis of some broad criteria. For example, the screening process may limit projects to areas in which the venture capitalist is familiar in terms of technology, product, or market scope. Now, the size of the investment, the geographical location, and stage of financing could also be used when it comes to the broad screening criteria. Now the next one is evaluation, or what we call as due diligence. Now the proposal is evaluated after screening and a detailed study of this particular project is done. Now some of the documents which are studied in details could be projected profile, track record of the entrepreneur, the future turnover that is expected. Now, the process of evaluation is always a thorough and detailed process, now which not only evaluates the project capacity but also it speaks about the capacity of the entrepreneurs to meet all such claims that they have proposed. Now, certain qualities in the entrepreneur, such as entrepreneurial skills, technical competencies, manufacturing and marketing capabilities, and experience, are put into consideration during evaluation. Now, after putting into consideration all the factors, through risk management is done, which is then followed by deal negotiation. Now, once the business proposal has passed through initial screening, it is subjected always for a detailed evaluation or due diligence process. Now, most ventures in which this venture capitalists fund are new and the entrepreneurs may lack operating experience. Though that is to tell, though they might have a bright idea, a new product, but then these new companies they would have lack of experience in the matter of how actually market works. Hence, a sophisticated or a formal evaluation is neither possible and is also not desirable. Now, the venture capitalists thus may rely on a subjective but a comprehensive evaluation. Now, they evaluate the quality of the entrepreneur before appraising the characteristics of the product, market, or for that matter, even technology. Now, most venture capitalists asks for a business to make an assessment of the possible risk and return on the venture. Now, the business plan contains a detailed information about the processed venture. Now, the evaluation of ventures by venture capital funds in India usually includes uh, some of the steps like first and foremost, uh, it in it includes preliminary evaluation. Now, under preliminary evaluation, what happens is that the applicants or those who seek want to see, want the help of venture capital, they are required to provide a brief profile of the proposed venture, and this is necessary to establish what we call as prima facie eligibility. Now, it should be such that the promoters of the business are also encouraged to have a face to face discussion to clarify the issues. Now, once after preliminary evaluation, the next thing is detailed evaluation. Now, once the project has crossed the qualifying hurdle through initial evaluation, the process is evaluated in greater detail. Now, a lot of stress is placed on techno-economic evaluation. Now, most of the venture capital funds involve experts for the technical appraisal whenever necessary. Now, speaking about this, the venture evaluation in India after the receipt of the business plan, they usually start with a detailed evaluation of the entrepreneur's background. Now, venture capital funds in India expect the entrepreneur usually to have, integrity, long-term vision, a urge to grow, the managerial skills, and also commercial orientation. Now, they also focus on the entrepreneur's technical ability or entrepreneurial skills, for that matter, also on manufacturing and marketable capabilities and experience. Now, after ascertaining the commitment of the entrepreneur, the project itself is evaluated in terms of the technological, manufacturing, and market viability. Now, the next thing that they do is risk analysis. Now, venture capital funds in India also usually makes uh, a thorough analysis of the risk of what venture is being proposed. Now, they generally analyze the product, market, technology, and entrepreneurial risk of the venture before they decide to finance it or not. Now, the first thing under that they would do is product risk. Now, in case of a new or untried ideas, there is a risk whether the product can be produced and commercialized. Now, technically sound products might sometimes fail on commercial basis. The next one is market risk. Now, market risk may result from several factors such as unexpected competition, problems of marketing channels, or non-acceptance by customer is also possible, or it might happen due to the quality, price, etc. The next one is technological risk. Now, technological risk arises especially when the entrepreneur lacks managerial capacity and when he is too optimistic, or for that matter, even too pessimistic. Now, speaking about the entrepreneurs, young innovative entrepreneurs may have bright ideas, but usually due to lack of experience they may fail to implement their ideas successfully. Now, venture capital funds take final decision with regard to financing new ventures in terms of expected risk return trade off, and it can be shown in terms of picture. Now, how this trade-off is done, like venture capital, this is the venture capital investment process. First, the screening would be done of the market, product, entrepreneurial, and the product. Then the evaluation is done, and based on the expected return, the approval would be given, and that makes up the decision. Now, the next one is deal structuring, or we can also call it as deal negotiation. Now, Once after the venture capitalists find the product beneficial, now he gets into deal negotiation. Now it is a process by which all the terms and conditions of the deal are formulated, and it would be formulated in such a way which would be mutually beneficial. Now, both the parties put forward their demands, and a way in between are sought to settle the demands. Now, some of the factors which are negotiated are amount of investment, percentage of profit held by both the parties, rights of the venture capitalist and the entrepreneur. Now, once after the venture has been evaluated as to be viable, the venture capitalist and the venture company negotiate the terms of the deal. It could be the amount, form, and price of the investment. Now, this process wherein they come up with the, all the conditions, terms is termed as deal structuring. Now, the agreement also includes the protective covenants and earnout arrangements. Now, to speak about covenants, these covenants include the venture capitalist's right to control the venture company and to change its management if at all it is necessary, or buyback arrangements, acquisition, initial public offering, or what we call as IPO. Now, earned out arrangements specify the entrepreneur's equity share and the objectives that are to be achieved. Now, speaking about this, venture capitalists generally negotiate deals to ensure the protection of their interest. Now, they would like the deal to provide for a certain commissioner rate with the risk and also influence over the firm through a board membership. Now, minimum taxes, investment liquidity, a right to replace the management in case of consistent poor managerial performance, and so on. The venture companies like the deals to be struck in such a way that their interests are always protected. Now, they would like to earn a reasonable return, minimize taxes, have enough liquidity to operate their business, and remain in commanding position of their business. Then there are number of common concerns shared by this both the venture capitalist and the venture company. Now, they should be flexible and have a structure that protects their interests and provides enough incentives to both to cooperate with each other. Now, the next one is post investment activities. Now, once the deal has been structured and also the agreement has been finalized, the venture capitalist generally assumes the role of partner and a collaborator. Now, he also gets involved in in the shaping of the venture. Now, this may be done through a formal representation of the board of directors or through informal influence in improving the quality of marketing, finance, and other managerial functions. Now, speaking about this, the degree of the venture capitalist's involvement depends upon his own policy. Now, it may not, however, be desirable for a venture capitalist to get involved in the day to day operations of the venture. Now, if a financial or managerial crisis occur, the venture capitalist may intervene and even install a new management team. Now, moving forward, the next one in the process and the last one in the process is the exit plan. Now, to speak about exit plan, that is nothing but now that I have invested in your business, once after the objective is achieved, how am I going to disinvest or how am I going to walk out of the company? Now, the last stage of the venture capital investment is to make the exit plan based on the nature of the investment. And also, it depends upon the extent and type of financial stake. Now, speaking about this, the exit plan is made to make minimum loss and maximum profit. Now, the venture capitalist might exit through IPOs or initial public offerings. That is to tell, until now, the investment was done on venture capitalists. Now they are going for IPO or for shares. It could be done by acquisition from some other company, or it can also be done by purchase of shares by venture capitalists or by promoters themselves or also by an outsider. Okay. Now the secondary or the over the counter market, which specializes in the trading of the shares of small companies, especially plays a crucial role in the exit through initial public offerings and acquisition. Okay. Now this is the process of how venture capital is financed. First, it is deal origination, screening, evaluation, deal structuring. Once after the deal is structured, the all the other activities, which is called as post investment activities, and the exit plan. Now we shall see the disinvestment mechanism, or mm, now, speaking about this, in the beginning, what do we mean by disinvestment? Now, when it comes to business, disinvestment means to sell off certain assets, maybe such as manufacturing plant, a division or subsidiary, or a product line. Now, sometimes disinvestment is described as the opposite of capital expenditure. Now, some people use the term, you know, divestiture or to divest when discussing regarding disinvestment. Now, for that matter, as an example can be taken. Now, when an electric generator manufacturer might sell off its consumer generator product lines and manufacturing facilities in order to raise money that can be used to expand its industrial generation product line. And one more example can be taken in terms of consumer products. Now, a consumer product company selling off a profitable division which might no longer meet its long range goals, and thereby the proceeds from this disinvestment are used to improve the company's financial position. Even that can be regarded as disinvestment. Now, the objective of a true venture capitalist is to sell off his investment at substantial capital gains. But most venture funds in India aim to operate on commercial lines along with satisfying their developmental objective. Now, the public sector venture funds invariably have some development objectives as well, and they would also like to disinvest their holdings at adequate return with a view to recycle funds. Now, a venture capital is generally not in a position to realize his investment before 5 to 7 years, as we discussed earlier. Now, there are different disinvestment options available to venture funds. Now, as discussed earlier, the disinvestment options generally available to venture capitalists could be in the form of promoters buyback, public issue, sale to other venture capital funds, sale in over the counter market or stock markets, management buyouts, and some other. Now, some of these are feasible options when it comes to Indian business market. Now in US, the venture capital industry from its beginning or inception had always access to well developed, efficiently functioning capital markets and later on to well developed over the counter stock markets. Now the stock markets and the over the counter markets in a number of European countries and a few developing countries, including India, are recent phenomena. So far, they have been using other avenues for disinvestment. And these avenues, although help to produce significant profit to investors, are always considered second best in comparison to stock market disinvestment. Now we shall discuss one by one form of disinvestment. And the most popular one in that is buyback by promoters. Now, this is the most popular disinvestment route in India in shares, that is buyback by promoters. Now, this route is suited to the Indian condition because it keeps the ownership and control of the promoters intact. Now, the obvious limitation, however, it has is that in a majority of cases, the market value of the shares of the venture firm would have appreciated so much after some years that the promoters would not be in a financial position to buy them back. Now, in India, the promoters are invariably given the first option to buy back the equity of their enterprises. Now, if the promoter fails to buy back the shares within the stipulated period, the venture capital fund reserves the discretion to disinvest them in any manner that seems to be appropriate. Now, venture capital funds generally make disinvestment in consultation with the promoter, usually after the project has settled down to a profitable level and the entrepreneur in a position to avail of finance under conventional scheme of assistance from banks or other financial institutions. Now, the next one that is there is initial public offerings. Now, the benefits of disinvestment through initial public offerings is also a route and also improves the marketability and liquidity and brings better prospects for capital gains and widely known status of the venture, as well as market control through public share participation. Now, this particular option has certain limitation when it comes to Indian context. Now, the promotion of the public issue would be difficult and expensive because the first generation entrepreneurs are not known in the capital markets. Now, further difficulties will be caused if the entrepreneur business is perceived to be unattractive investment proposition by investors. Now, also, the emphasis by the Indian investors on short term profits and dividends may lead to make market price unattractive. Even after so many problems, there is yet another difficulty in India until recently was that the controller of capital issue or the CCI guidelines for determining premium on shares took into account the book value and the cumulative averages of earning per share till the date of the new issue. Now, this formula failed to give due weightage to the expected stream of earnings of the venture firm. Now, the formula would underestimate the premium. Now, the government has abolished the Capital Issue Control Act 1947, 1947, and as the consequence, the officer of the capital issue. The existing companies are now, free to fix the share price. The public issue form of investment will always involve high transaction cost. Now, that is mainly due to the inefficiency of the secondary market in our country. Now, also, this option has been rendered far less feasible, especially for small ventures, because of the higher listing requirement of the stock exchange. The next one is secondary stock market. Now, market that is especially secondary capital market provides the necessary inputs to success of venture capital. Now, venture capital funds should be able to sell their holdings and investors should be able to trade shares conveniently and freely. In countries like US, there exists a well developed over the counter market where dealers trade in shares through terminal. Such mechanism enables new small companies to enlist on the over the counter market which are not otherwise eligible to be listed on stock exchange and provides liquidity to investors. The last one is management buyouts. Now, the promoter of a new venture which has taken off may sell it to its managers. The managers will generally raise venture capital to buy out the venture. This transaction is called as management buyouts when the managers incur heavy debt to buy the venture. Now, the deal is also called as leveraged buyout. Management buyouts will take place in case, especially of those ventures which have high growth potential in the future. Now, after acquiring the venture, if they are able to convert the high growth of the business in high profitable and value, they could always make substantial gains. But there is a high risk as the potential growth may not realized later on. Now, management buyouts, when it comes to Indian context, are not very much popular. We have still more discussion that is to be made. For today's session, let us stop here, and in our coming session